So I'm about to tell you that 500 bucks a month can make you a millionaire. And I already know exactly what your face is doing right now. Mine did the same thing the first time I ran the numbers, because it sounds like one of those 2 a.m. rented Lamborghini make money while you sleep things, right? It's not. It's just math. Boring, patient, kind of beautiful math. And the only reason nobody believes it is that the first part, the part you actually live through, feels like nothing is happening. So let me just walk you through it, year by year. What it looks like to put away $500 a month, what you'll feel, what your account will say, and the exact moment it stops being about you and starts running on its own. If you've ever thought you started too late, or that investing is for finance bros and little vests, stay with me, especially through the year one part, because that's where almost everybody quits, like right before it gets good.
Okay, year one. And I have to be straight with you because that's the deal here. Year one is so boring it almost feels broken. You put in $500 a month, 12 months, that's $6,000 of your own money gone from your checking account into this index fund thing we'll talk about in a second. And at the end of the year, you've got about $6,280. $280 for a whole year. That's the big reward. That's one nice dinner where you don't look at the right side of the menu. And this is the exact spot where people quit. They do it for 8 months, they don't feel rich, the numbers barely moved, and they go, yeah, this is pointless, and they buy a PlayStation instead. And I get it, I really do. But you didn't show up here for the 8-month payoff, you showed up for the 30-year one. Year one is just the cover charge to get in the door. Real quick, since I keep saying index fund, let me strip the jargon off it. An index fund is just a way to buy a tiny sliver of basically every big company at once, in one click. You're not betting on one horse, you're buying the whole racetrack. People use the S&P 500 or a total market fund. You'll see little codes like VOO or VTI, and those codes are just airport codes for stocks. SFO gets you to San Francisco. VOO gets you the 500 biggest companies in America. That's the whole thing. That's the secret the guys in suits charged your parents a fortune for. So year one, your only job is this: build the pipe. Set up the 500 so it leaves your account on its own, same day every month before you've had a chance to talk yourself out of it, and then kind of forget about it.
Now jump ahead, 10 years in. By now you've put in 60 grand. 500 a month, 10 years, 60,000 of your actual dollars. And your account is sitting at around 102,000. Sit with that for a sec. You put in 60, you've got 102. Something, and you didn't lift a finger, quietly handed you $42,000. That's the first time you can actually feel your money pulling a shift, instead of it doing all you. There's this line from Charlie Munger, Warren Buffett's business partner for like 50 years. Very sharp, very blunt old guy. And I'll keep it PG, but he basically said, the first 100 grand is a brutal grind, and you just have to claw your way there however you can. And he's right. The first 100K is the hard part, because early on, you are the engine. Your savings are doing the heavy lifting, not your returns. That flips later, hard. But right now, every single 500 matters more than it ever will again. Got a whole video on why the first 100K is a totally different game. It's linked down below. One tying trick so you can do this in your head forever: the rule of 72. Take 72, divide it by your return. At around 10%, that's 72 over 10. So roughly every 7 years, whatever you've built doubles itself, for free, while you're asleep or at brunch or losing an argument in a comment section. So, the year 10 lesson is just do not stop here. This is the worst possible place to quit, and it's exactly where people do it.
Year 20. Okay, this one's my favorite because this is where the whole thing kind of leaves your hands. 20 years of 500 a month. You've put in 120 grand total. Your account? Somewhere around 380,000. So out of that 380, only 120 is money you saved. The other 260,000 is just growth. Your money having babies, and then those babies going out and getting jobs. For the first time ever, the gains are bigger than everything you put in combined. You quietly became a minority investor in your own net worth, which sounds weird, but it might be the best news in this entire video. This is the thing people mean when they throw around compound interest, that quote everybody slaps onto Einstein, eighth wonder of the world, whatever. Doesn't matter if he said it. Morgan Housel wrote this great book, The Psychology of Money, and his whole point is that the magic was never crazy returns. It's decent returns left completely alone for an absurdly long time. The secret ingredient is not touching it. Boredom, basically. Boredom is the strategy. Now, somebody's already typing, but what about when the market crashes? And yeah, it will. It'll drop 20, 30%, your stomach will do a backflip, and you will feel extremely smart for wanting to sell everything. Don't. A crash when you're still buying every single month is just the same stuff going on sale. You want it cheaper. The only people a crash actually hurts are the ones who panic and sell at the bottom. So this year's whole job is nothing. Sit on your hands. Keep the 500 going. That's the move. That's the entire move.
All right, year 30. Deep breath, because here's the headline, and it's the one that sounds completely made up. 30 years, 500 a month. Over those 3 decades, you put in $180,000 of your own money, and your account is worth about $1.13 million. $1 million from $500 a month. You put in 180 grand, and the market just tacked on another 950,000 on top of it. You did maybe 16% of the work. The rest was time. And look, I'm not going to lie to you and pretend the market hands you a clean 10% every year, because it doesn't. Some years are great. Some years are flat out ugly. If we run it more pessimistic, say 8% a year, that same 30 years lands closer to 745,000 instead of the full 1.1. Still, $750,000, built from a number you could probably free up by cooking at home a few more nights a week and being a little less friendly with the DoorDash app. Quick disclaimer so nobody comes for me. Nobody can promise you any of these returns. The past isn't a guarantee. This is illustrative. But the engine under it is real, and it's been real for a very long time. This is also the part I wish I could beat into a few of my friends' heads. I've got buddies who out-earn me by a mile, like a stupid amount more, and a couple of them couldn't tell you their net worth within 50 grand if you held a gun to them. Meanwhile, there's this famous study that became a book, The Millionaire Next Door, and they found that the real millionaires usually look boring. Normal car, normal house. They just quietly kept a big chunk of what they made and let it cook. It was never about the income. It's about the part of the income you actually keep.
Last stop, year 40. And this is the one that should really mess with how you look at that $500. 40 years of $500 a month. Total you put in over your whole life? $240,000. Your account? Somewhere north of 3 million, like 3.16. You put in $250,000 across your entire life. The market handed you the other 2.9 million. At this point, your money is earning more in a single year by itself than a lot of people make at their jobs. And it never asks for a day off, never gets sick, and never shows up Monday with an attitude. That's the snowball at full speed. And it is the entire reason I get a little intense about starting early, even if it's tiny. $1 you invest at 25 gets 40 years to roll downhill. The same dollar at 45 only gets 20. Same dollar, wildly, almost unfairly different ending, because the early ones have the one thing you cannot buy more of later, no matter how rich you get, which is time. And yeah, I know, 3 million in 40 years isn't 3 million in today's money. Inflation nibbles away at it. That's real. I'm not going to pretend it doesn't. But here's the trap hiding inside that worry. Doing nothing doesn't beat inflation either. Cash under the mattress is a guaranteed slow leak. Owning a piece of the whole economy is one of the few things that's historically stayed ahead of it. So the scary option and the safe-feeling option kind of quietly swap places.
Okay, fine. I'm in, but where does the money physically go? Great question. Let me make it dead simple. In order. If your job matches your 401k, start there. No contest, no debate. That's free money, an instant 100% return, and watching people skip it makes me want to go lie down. After that, a Roth IRA.
Money that's already been taxed going in, and then it grows and comes out completely tax-free later, which is kind of wild when you stretch it over decades. Then, if you've still got room, a regular brokerage account. And if you ever get access to an HSA, that thing's a little tax unicorn. I've got a separate video, it's linked. But inside every single one of these accounts, you're just buying that same boring index fund. The account is the bag, the index fund is the snacks inside the bag. Now, some of you have been sitting there this whole time going, cool story, I don't have $500 a month, what is this? And I hear you. I'm not going to sit up here and pretend money's easy or that the stress around it isn't real. It is, and there is zero shame in any of it. My dad grew up poor in Shanghai, like the real kind of poor. He tells this story about how a treat, was a plain steamed bun. No filling, no nothing, just bread. That was the good day. He'd watch this video here, just invest $500 a month, and quietly assume we'd all lost our minds. So here's the actual move. The $500 is the finish line, not the entry fee. Start at 50, start at 100. I'm dead serious. The exact number matters way, way less than the habit and the years. A small amount you actually keep doing for 30 years beats a perfect plan you keep meaning to start next month. Build the pipe, turn it on, even if barely anything's flowing through it yet. You widen it later as you earn more. Just please don't let your spending grow at the exact same speed as your paychecks. Do that and you'll be doing the same dance at 60.
So that's the whole arc. Year 1, you feel nothing. Year 10, 6 figures and the first little sign of life. Year 20, it stops being about you. Year 30, you're somehow a millionaire. Year 40, your money's working harder than you are. And if you back all the way up, none of this was ever really about the $500. It was about doing one small, boring, automatic thing, and then getting out of its way long enough for time to do the heavy lifting. That's the whole game. Money was never supposed to be a scoreboard you wave in people's faces. It's a tool to worry less, sleep a little better, and eventually buy back your own time, which, when you really sit with it, is the only thing not one of us can ever earn more of. You don't wait until you're rich to start. Starting is the part that makes you rich.